Hello and welcome to this Spears webinar in association with Clarity AI. Our title today is What the New MiFID II Requirements Really Mean for the Future of Sustainable Investing. My name is Edwin Smith, I'm the editor of Spears, and I'm very pleased to say that I'm joined by a panel of leading experts. They are Pilar Galan, partner and head of the Legal Financial Services Department at KPMG Abogados, Dr. Jan Amrit Poser, Chief Sustainable Investment Officer at Radicant, Rodolphe Bocquet, VP of Partnerships and Regulations at Clarity AI, and Lydia Pinnell, Head of Wealth Strategy, also at Clarity AI. Thank you all for joining me. Now, the demand for and sophistication of sustainable investment offerings continues to grow, but a new addition to MiFID II is set to have deep and wide-ranging implications for the investment industry at large. In this webinar, we will discuss what the latest developments mean for investors, the firms that serve them, and for the future of the investment landscape. But first, a short note on our sponsors. Clarity AI is a sustainable technology platform that uses machine learning and big data to deliver environmental and social insights to investors, companies, governments, and consumers. It analyzes more than 50,000 companies, 300,000 funds, 198 countries, and 188 local governments. It delivers data and analytics for investing, corporate research, and reporting. Clarity AI's client network has more than $30 trillion in assets under management, and its minority investors include BlackRock, Deutsche Börse, and SoftBank. Okay, so Lydia and Rodolphe, you really know what you're talking about, as do our other two guests, of course. A great panel assembled today. And so to kick us off, Jan, I'd like to start with you, if you don't mind. But before we get going for real, could you just tell us a little bit about your role and how it informs your view of this subject?
Yeah, I'm really happy to join this panel here on this very important subject. So I've been 21 years with J. Safra Sarasin, which is a pioneer in Switzerland in sustainable finance, so doing sustainable finance since more than 30 years. And then I wanted to go the next step in my career, really, to join a startup to build Switzerland's first sustainable, collaborative, and digital bank and a life companion, actually, to create kind of a new banking experience and also a good banking experience, because we want to be fully aligned with the sustainable development goals and really align all our products, be it investments or be it payments and advice with the Sustainable Development Goals. And then I'm the Chief Sustainable Investment Officer, who is overseeing the whole investment value chain. Yeah, I think the growth in sustainable finance has been tremendous. And if you look at the last 30 years, basically, of course, there was the time when it was a little bit of an up and down, and some people called it a fad, but since 2006, I think we have had the PRI ramping up the demand very strongly. We have now 3,000 signatories there with the PRI representing 100 trillion assets under management, which is a tremendous success on the institutional space. And obviously, since Glasgow, the COP26 conference, we now have the Glasgow Financial Alliance for Net Zero, which is counting almost $50 trillion on top for sustainable finance. Now, I think the next step is really being taken by the private sector, because if we look at all the private assets in the world, I think the Global Sustainable Investment Alliance counts it for around $35 trillion, which compares still quite small to the institutional amounts. But obviously the growth is very strong with 15%. Here in Switzerland, we had last year 100% growth in the funds business, which is of course related to the fact that there are now these mechanisms kicking in, like MiFID, really kickstarting the private sector demand. Because what MiFID basically does is it obliges all advisors to ask for ESG preferences. And now that's unheard of to some extent, because advisors were kind of timid to ask their clients. And obviously they try to to keep basically not to talk too much about sustainable finance. Now they are obliged, and once they ask their clients, actually the clients often say yes. There's a study by the University of Zurich and the University of Harvard actually showing that mostly, if asked whether you want to embed sustainability preferences, actually most clients will say yes. And this is now kickstarting the whole process. And I think the growth over the next years will be tremendous due to MiFID.
Okay, fantastic. So yeah, various drivers, but interest and appetite for sustainable investing on the rise. One of the other things that we want to talk about today, and which kind of fits into this, is the increased degree of personalization that might be coming down the track. Lydia, can I turn to you and ask for a sort of high-level summary of how that's part of this conversation?
Yes, absolutely. So very thankful to be here and happy to share my background because it is slightly different by default. I am sitting in Miami, Florida today, so actually not in Europe, although we do see more and more with U.S. banks and wealth institutions that have exposure. So important even in the U.S. as well. But my seat, where I come from, is a little under 10 years as a financial advisor at Goldman Sachs. So things that I'll be focused on today is really that client and an advisor relationship as I've sat in that chair and really understood the process and how you personalize portfolios. And at the time, it was for ultra high net worth or billionaire clients. And I took a slight career shift and went to focus more on the technology route because I saw that through personalization, you could actually target much lower ends of that wealth spectrum. So went to a more retail focused asset manager where we were developing internal solutions to better personalize across the capture of a client preferences, which obviously is related to our suitability and sustainability topic here today.
Excellent. And so with that high-level context, which will frame our conversation really well, I want to start to look at these changes to MiFID II that have come in. Pilar, can I turn to you now and first ask you, as we have done with the other panelists, to tell us a little bit about your background, but then once that's under our belts, then perhaps set the stage for you to provide a bit of a briefing regarding these changes and the timetable of them coming in and their various elements.
Well, thank you very much for the invitation to be here today. It's really a pleasure, especially with this panel. Well, I'm a partner in KPMG Spain, and I also lead I'm also the global lead for ESG in legal of KPMG. With my role, I'm not only contributing to the ESG strategy of KPMG, but I'm also involved and I'm leading the main financial sector projects for implementing SFDR and MiFID II, and therefore we are having quite a lot of work in this field. Regarding the changes and the timetable, well, I think the first thing to highlight is that really there is a lot of complexity also in this topic. We already know that MiFID II is very complex. Well, with these sustainable finance requirements, we are not going to simplify it. The MiFID II amendments come mainly because of the EU Action Plan for Sustainable Finance, where it was approved first what we call the SFDR, so the Sustainable Finance Disclosure Regulation, which is mainly a transparency regulation in order to implement transparency requirements regarding whether you are integrating ESG factors or in order to introduce transparency in the pre-contractual and post-contractual information that you give to the clients. But now with the MiFID II requirements, the regulator introduces changes in the suitability test and also in the product governance requirements. So what is intended is that the asset managers and the wealth managers, they have to ask their clients whether they have sustainable preferences, and with that information adapt the proposals or the portfolios that they structure for the clients. So it has, or it potentially has, a great impact in the in the asset management and in the advisory services that asset managers give to their clients. I think that probably the main challenges are, first, the data challenge, where Clarity is trying to help a lot, but really the market is working hard on compiling the information and the data that is required in order to be able to classify the products so that, according to the preferences for sustainability of the clients, they can offer them. But the truth is that because of this, lack of data in many cases, and the lack of catalog of products, many entities are really facing a big challenge in order to adapt. Also because, the clients are not used to speaking about ESG factors, so it is not easy for them to understand. If you ask them in a very simple way whether they want to take into account sustainable factors, they are going to answer yes. But the thing is that it's not that simple. The regulation asks you to differentiate between taxonomy alignment, SFDR, or sustainable products, and so on, and that's not easy to understand by clients. And of course, and I would stop just a second on this, the uncertainty on the requirements, on the regulatory criteria, because we really are lacking for development by the regulator in order to, or we are missing those developments in order to really implement it. You have to take into account that the suitability test had to be modified at the beginning of August, and we do not have the ESMA guidelines yet. We are expecting to have them at the end of this month or at the beginning of October, but there is a big delay on this. So what the clients have done is implement or modify the tests, their suitability tests, knowing that they are going to have to modify it again in the coming months. So that's a huge investment for clients, and it's also very hard to understand by the clients.
Okay, excellent. Rodolphe, can I come to you now? You're VP of Partnerships and Regulations at Clarity. First, can you just tell us a little bit about what that involves?
Yes, sure. Hi, everyone. It's a pleasure to be here. So VP of Partnerships and Regulation means that I care for partnerships, which we see as our external innovation engine at Clarity, and allows us to innovate in domains where we couldn't achieve our goals on our own. And we do partner with a very different kind of institution, from academics to NGOs, corporate tech companies, sustainable investment industry. So the range is very wide. And I'm also VP of Regulation, which means that I'm involved in assessing upcoming regulation and how they're going to impact our industry. I'm a member of the EFRAG CSRD expert working group, and try to be involved in assessing upcoming regulatory trends and seeing how this will impact, for example, our product roadmap and the needs of our clients. Beyond that, I've been in the field of sustainable investment and environmental finance for the last 20 years, both in the public and the private sector.
Great. And I mean, Pilar's answer there gave us a sense of how complicated this picture is and how the regulations have many moving parts to them and so forth. But in your view, can you give us sort of in a nutshell version, a short précis of how MiFID II is changing things?
Yeah, so it's a bit paradoxical. It's at the same time potentially one of the greatest simplification of the sustainable investment industry, and I will explain why in 1 second. But also a complicated process. Why is it potentially a big revolution, which is going to simplify the life of asset managers? It's because almost as long as sustainable investment has existed, there's been a debate about is sustainable investment or ESG compatible with fiduciary duties. And a first answer to that has been ESG integration, which is focusing on the financial materiality of ESG and how integration of sustainability factors is a meaningful additional a piece of information to inform risk return assessment in portfolio construction and management. But of course, sustainability investment is more than ESG integration. It's also about values and preference of investors, the choice of not being exposed to certain sectors because of one's personal values. And it's also about impact, about how companies do impact the outside world, and not only about how sustainability is going to impact the enterprise value of invested companies. So where MiFID is really bringing a Copernican revolution is that because it opens the way for systematically assessing final investor sustainability preference alongside as the assessment of their financial risk profile, then it becomes legitimate based on the answer of the final investors to integrate in whatever manner their sustainability preferences. So the very hot debate that we saw even during the summer in the US in certain states about the legal characteristic of sustainability investment is over if you think about MiFID and the way it's implemented. So in that sense, it's a big simplification, a big step forward. But in the implementation phase of MiFID, as Pina alluded to, that's where it becomes a bit more difficult because it's one thing to assess final investor preferences, and it's another one from a regulatory point of view to connect it with the regulatory framework and to make the client's experience seamless without misrepresenting and mis-selling any kind of products.
Absolutely. And on client experience, Lydia, I know this is an area that you look at quite closely. Can you tell us what sorts of things you're starting to see in that space?
Absolutely. And I'll even take a step back and use the example in the United States, what we experience with the best interest regulation. So just to set the framework, best interest started about 3 to 5 years ago, and essentially half of the regulatory oversight was a fiduciary standard that we globally understand, and the other was a suitability standard. And so best interest raised that suitability standard to be much closer in line with the fiduciary standard. I'm explaining all this because it's very similar to what's happened now in this implementation phase. So we heard Pilar talk about complex, and we heard her talk about uncertainty. So that creates a lot of swirl for internal organizations to make effective decisions. Which providers are we going to use? What data are we going to use? What's the bare minimum to get this done, right? So yes, there's urgency to get it done, but something that we saw happen sort of in year 3, 4, 5 of the winners in the United States, they actually implemented best interest in a way that hyper-focused on the client experience, not just a behind the scenes check the box. So they actually took a regulatory direction and demand and turned it into a value add for them. And that all centered around the client experience, how advisors and clients were speaking about it. Because also, as we heard from Pilar and Rudolph, that clients don't necessarily know how to ask for what they want in ESG. So that's a very important grounding thing that people can turn into value.
Absolutely. And this MiFID II regulation, as you mentioned, that doesn't affect the US directly, but we're still seeing a development of the sophistication of sustainability investment offerings in the US. Can you talk about the other things that are driving it?
Yeah, absolutely. So I think one thing is people expect personalization and sophistication, and even outside of that high net worth experience. Last night I ordered a burrito and I got to select what bean I had, and I got to select how I wanted it delivered, touch my doorbell or no contact, right? So it's expected that clients and advisors want the same experience for their financial services delivery and now their sustainability delivery. So that's one aspect. I would say the other aspect is technology. If you use direct indexing as an example, for instance, it used to be reserved for the billionaires. It was $1 million minimum. It was a manual process with Excel sheets. Now there are actually systems that can make it faster, and advisors can scale that investment strategy. And that's something very similar that we could translate over to sustainability preferences as well now. And you don't need $1 million for an account minimum. It's going lower and lower and lower. And the last thing, which is near and dear to us at Clarity, is actually having the data in a transparent, non-generic way so that you can actually slice through a generic score that means nothing, and you can cater it to a preference into your investment process without needing to go out and learn an entire new investment sustainability process, but actually start integrating those preferences from MiFID requirements into your workflow.
Okay, sure. And Pilar, can we get another European sort of perspective on this again? There's different things going on either side of the Atlantic, but do you think there are learnings for each party in this? Are there things that Europe can learn from what's happening in America? Are there things that America can learn from what's happening in Europe?
Well, I think that, Jan said it before, that regulation is proving to be useful in order to increase the private investment in sustainability projects or assets. But it is very important to guarantee the legal certainty. So it's very important to really implement this with clear guidance by the regulators about what are they referring with the different concepts, so that it doesn't provoke what we have in Europe, where the differences between the different jurisdictions because of the interpretation of what is sustainable, what is not, and how to catalog some products in terms of the methodology. And so that's very important. And also, I think it's important to balance. Since the beginning, the regulators said very clearly that they did want to avoid greenwashing. But really, the difficulties in really understanding the regulation and the different criteria when interpreting what is green and what is not may lead to greenwashing problems. So, and in many cases, also involving reputational risks of entities that did want to comply, but because of their need to interpret the regulation, may be falling in or a different interpretation than that of the regulator. And so I think that is very important to really guarantee that that's a clear guidance, and to also try to help in order to avoid those greenwashing problems that may arise.
Absolutely, and that's one of the stated aims of this regulation, to avoid greenwashing. Jan, can I just ask you quickly on that point? Is that being achieved? Is that likely to be achieved?
Yes, well, I think so. If you look at this EU regulation, actually, it was one of the fastest pieces of regulation that kicked in, and really, came to fruition. This is maybe also some of the criticism pertains to that it is, of course, very fast. They throw it like a bomb at the market, and then they see how the market behaves, and then it's only after the fact that you see the clarifications and the legal certainty that Pilar was talking about. But it is clear that they started with the definition of what is sustainable and what the action plan wants to have financed by the private sector, and now it is basically creating the demand for it from the by obliging the advisors to ask the sustainability preferences. And it has a huge impact on the market in one respect, I think, which is that the questions that we are supposed to be asking are relatively clear cut, because it's always about the impact of a company, right? We need to ask whether our approach includes principal adverse sustainability impacts, right? Always the impact of a company. Or we are obliged to ask the question whether the clients like to finance the activities that the European Union has in the taxonomy defined as sustainable, or some other sustainable activity which may be close to what the European Union was thinking was sustainable. And that means that actually this tendency of creating an ESG light approach, which includes a bit of ESG data but not too much, is actually being phased out, and because the MiFID preferences clearly require us to ask the question about the impact of companies, which is basically the next step. And if you look at the fund landscape currently, Morningstar has found out that actually only 4% of all the funds in Europe are currently like Article 9, so impact of companies oriented. And it is clear that there will be a huge shift towards this segment in order to finance basically the action plan of the European Union towards sustainable finance. So it has a huge impact, and I think by obliging everybody to disclose the data, it is clearly kind of obstructing any greenwashing here. You have to clearly disclose what you're doing, your methodology, your data providers, and basically what you're doing with the data.
Okay, I'm a journalist, so I'm looking for a headline here. Greenwashing is a thing of the past soon, or it soon will be.
Well, I mean, there will always be people who pretend to do something, but what is clear is that it becomes much harder if you can factually compare the holdings of funds and basically really show what kind of impacts you're investing in or even financing, and that will be something which will be which will create complete transparency throughout the European landscape.
Very good, thank you. Yeah, and so on this question of Europe and the US, Lydia, can I just ask your view of how you think the two markets sort of are influencing each other at the moment, and perhaps how they might influence each other more or less in the future?
Absolutely. When we look at how further along Europe is compared to the United States in sustainability specifically, it's a bit sad. We're finally catching up, but that's where we're going to do a lot of learning. And if you think about it, Europe is helping develop frameworks. Regulators understand the sustainability frameworks that's been set out and adopted by many around the world globally. And they're using that to build smart, accountable frameworks where everyone can get behind. So what Jan was saying is you really need to know what problem you're solving for. And this helps break open the ability that we'll be able to take that data and then, for instance, in Clarity AI solution, present it in a way that then can be translated and make sense to a client's sustainability preferences within and along an advisor's investment process. So from that standpoint, we're going to learn so much by this period of implementation from MiFID, absolutely. And then on the flip side, I think from that experience standpoint, Europe has something to learn from there versus a check the box, and expanding on that into more of a value-oriented approach. However, absolutely, Europe is leading the way in terms of sustainability.
Okay, great. And so at this juncture, Rudolf, I might wonder if I might turn to you, because I think it would be nice to have a little bit more context about the sorts of services that Clarity AI offers clients and why it's so relevant to this conversation. I mean, Lydia's given us a really good sense of it already, but can you expand on some of what she said and perhaps give us a bit more detail?
Yeah, sure. Perhaps before answering your question, I'd like to react to the previous question and your discussion with Jan and the risk of greenwashing. It's very interesting to see that actually the opposite is happening. What is the opposite of greenwashing? It's a new term that I've read in an article recently. It's called green bleaching, and it means that because of the regulatory pressure that exists now, some asset managers, some fund managers are understating the sustainability ambition of their approach, just to make sure that they will not be caught by the regulator in under delivering what they promise. So I just wanted to mention that. To your points about Clarity, I think as I was mentioning earlier, we should really grasp the full ambition of what is happening with the European-led evolution of sustainable investment regulation. And it's really a revolution underway that is influencing beyond the borders of Europe. This regulatory evolution is aiming at setting an overall common language so that people understand what type of fund they can invest in and what is the specific type of information these funds need to report depending on their nature. So that's SFDR, but there is also the taxonomy to define a common framework to assess how certain activities contribute to environmental objectives, and more globally, a definition about sustainable investment. So that's really very ambitious, and once this will be in place, this will be a whole new framework to channel investment toward a sustainable development pathway. But currently, there is a big missing piece in the puzzle, and that missing piece is data, as what was mentioned by Pina. For some reasons that I don't know, the European regulator has decided to implement this obligation of reporting on investors, financial market participants, before it put additional regulatory obligations to report this data. So we are in a very funny situation where there is need to report a lot of new information and the data does not exist. So what we do at Clarity AI is developing a very ambitious approach based on technology and AI and modeling, algorithm, machine learning, and natural language processing approaches to do two things. First, to do some reliability check of the data that is reported. It's not because the data is being reported by a company that the data is right. Let me take an example. If you look at Scope 3 data for greenhouse gas emission, this is data that can only be modeled, even by companies themselves. And we've done some studies that are very much aligned with similar studies done by Harvard and CDP that shows that Scope 3 data are structurally underreported, underestimated by companies. So there is a need for reliability check of data reported by company, and that's something that technology is very good at and that we implement at Clarity AI. And then once we have reliable data sets, thanks to our algorithm, we can develop models to expand the coverage and meet the need of investors. That's how, for example, to stick with my greenhouse gas emission example, on scope 1 and 2, we are able to expand the 7,000 companies that are reporting publicly their greenhouse gas emission to over 30,000 companies. And that with the full transparency, which is a key component for regulatory purposes. So for each data point, you will know where it comes from, how it's been computed, if it's reported or an output of the model. And if it's an output of the model, what is the level of uncertainty of the estimation. So this technology approach to data is a key service that is providing a ground foundation for meaningful regulatory compliance, especially with SFDR, taxonomy, and MiFID. And the other part is that data is one thing, but data is not enough. You need also capabilities, so tools that will allow you to use this data in a meaningful way. So you can have data describing companies, but then you might be investing in funds. You will have some portfolio, and in this portfolio, you will have different type of assets. So you need tools that allow you to aggregate this data in a very simple way to get results across asset classes and at fund level with a complete look through and ability to navigate all of these data at the different granularity levels, and that's what we do at Clarity AI.
Okay, very good. This reliability check, could we get a sense of how that works? An example of it, perhaps? I don't know if that's better for Lydia to come in on or for you, Rudolf.
Yeah, so at Clarity AI, we have three sources of data. We have a third-party data provider, we have data that we collect ourselves, and then we have our algorithm. And what we do is, for many data points, we get different data sources. And we will compare these different sources for a given data point, and also with the output of our own models. And that will allow us to detect outlier or data that are not reliable, and then to investigate why this data is not reliable. In some instances, for example, it's company that will report only on a part of their activity, or a data provider that will have collected data reported by a company but will have missed something in the report or done just a mistake, misinterpreting the unit of the data that is being reported.
Okay, excellent. And so we're starting to see, with all these tools come into play and with them being used effectively by the businesses that choose to do that, we might start to see the realization of what Lydia was talking about earlier and what, Jan, you've already mentioned, this democratization of sort of private banking level personalization services for clients who don't necessarily have tens of millions to invest. Jan, can you talk a bit about that, what you expect to see, how you expect that to evolve?
Yes, absolutely. So in the last years, I mean, sustainable finance, or many of those products were only created for really high net worth individuals or people, above $1 million US dollars in net wealth, and Radicant is there really to democratize this market, this private banking market with technology to provide full transparency. I think this is what the market is also craving for, to see why a company is sustainable or aligned with the Sustainable Development Goals of the UNO, and obviously to also have access to data, and this is why we're in the process of, on the one hand side, creating with our methodology based on data like Clarity AI data, the kind of impactful financial instruments and mandates to build them aligned with the SDGs on the one hand side, but on the other side, you can use this for advisory mandates to really make sure that you get the data from, for example, Clarity AI, and sort them, and let the client on the technology platform that we are providing choose how he wants to slice and dice basically his own portfolio, and then provide full transparency with the data that we buy to the client, so that the client can really create his or her own impactful portfolio. And this is really the use case of such data that you can provide.
Okay, fantastic. And I mean, in the Spears network, we deal with wealth management firms and so on who only, or certain wealth managers at those firms might only deal with a client if he or she has above 100 million US dollars to invest, that sort of thing. If you were one of those firms, would you start looking at this phenomenon and think, okay, I've got to get ahead of this. I've got to look to the next step and develop and think about what's coming down the track?
Yeah, yes, absolutely. Because I mean, well, we understand ourselves as a technology company more than a bank, but we are, of course, a regulated bank as well. We have a license, and basically, it is clear that technology will disrupt the whole market, and Clarity AI is one of those disruptors, and providers like us are another of those disruptors. So suddenly, what was withheld for very high net worth individuals is now being fully democratized and can be used for everybody. So that is really the idea of big data on the one hand side and technology platforms on the other side, and then you'll have the app where you can see everything that you want to see in terms of how your portfolio is aligned and how each company is scoring on some of those impact metrics.
Okay, excellent. And one of the things that I wanted us to talk about today was the risks, some of the risks in this space. And we've seen the SEC in the US earlier this year establish a task force to root out misconduct related to ESG issues. And there are some notable examples of them having got hold of some of this misconduct or alleged misconduct in any case. What does that tell us about what's going on in this space? Lydia, this might be one for you, I suspect, or possibly Pilar. Lydia, I think if you have a thought on this, I'd be happy to hear it.
Yeah, sure. So I think what it means is you can't shy away from it. It's happening. And so right now, it's not only real risk from regulators, but it's headline risk. So it all goes back into doing the right thing, really understanding where the puck is going so that you are there far before your clients expect that detailed personalization. And we're seeing a lot more inbound calls about these headlines because firms, they want to know, are we implementing our ESG strategies as we say we are? They even want a third party to do a triple check to make sure that they're approaching it and solve the problems that they say that they're solving. So from our point of view, these headlines help everyone move in the right direction and do the right thing for their client, but also in the name of sustainability and the future of our Earth.
Absolutely.
Edwin, if I may chip in there, I think you're referring to a very high-profile case where basically greenwashing was alleged because basically it was the old process of using ESG data and then saying, okay, we provide it to all the PMs, and once we've provided it to all the PMs, they have access to it, and then we can report that all our assets are basically ESG enhanced, although none of the PM is really using that data, right? That will be a thing of the past, as we said before, and if MiFID comes to play, because this approach will no longer be eligible under MiFID under the MiFID rules and basically under the MiFID preferences. So this is one thing where Europe is moving. Coming back to where the US is moving, I mean, the SEC had this investigation, obviously, but there is a big reactionary movement now going on in the US with the governor of Florida or the Texas attorneys basically disallowing companies to use ESG because it is just values-based investing, which we know it isn't, because ESG has value, is something which you can use as an additional information to increase or enhance your portfolios and also measure the impact. But that is the big battle going on currently, and I think the US is unfortunately more moving back to let's say, banning values-based investments, while Europe is clearly moving into the impact investment direction now.
Yeah.
But just to be a little controversial here,
Please.
I think that MiFID II introduces all these sustainability preferences that you have to ask to the clients, and the draft guidelines of ESMA, they introduce the idea that if the client tells you that they have certain sustainable preferences and you do not have products or a catalog of products according to that, then you have to tell them, and if they don't change the preferences, then you cannot offer them the products. So I think there is a risk there, because if instead of using the data that is available and using that criteria in order to properly classify the products according to what is sustainable or what is green, if you have the risk of not having a catalog and therefore not being able to provide that service to the clients according to those preferences, then I think there is the risk of some entities or of a lax interpretation or a less conservative interpretation of what is green or what is sustainable in order to be able to classify the majority of your portfolio, of your catalog of products in terms of green or sustainable. So I think that's why I was saying before that there are a lot of reputational risks if you don't act properly and you do not really aim to really provide the best service to the client, really being transparent about what you are really offering them. And I think it's especially the market who is going to play that role more than the regulators or the supervisors. I think that's really the market is going to probably, once they understand better the data and once they understand better the concepts, they are probably going to ask to go further and further. But this is just in order to be controversial about this, because I think there is a risk there.
I take the point. I think what is clear already from the regulation is you will be safe if you offer Article 9 products or dark green products according to SFDR once the client expresses the preferences in ESG. And I think that therefore there will be a shift towards Article 9. And if the client advisor says, imagine your client advisor asks you, so are you interested in sustainability? And then the client says, yes, I am. And then you say, well, actually, I don't have any products. Well, I think there's a big risk for the advisors really to lose out in this process. And I think this is why everybody's ramping up on capacity in terms of ESG currently.
And I just want to add one overlay comment about the importance of the solution that firms are implementing with, because you really want to partner with somebody that is addressing every regulatory framework that was mentioned in MiFID II. Because what happens is if you have a client, or let's say a certain framework really takes steam and you have more people asking for that, but you don't have the internal capabilities to classify based on that framework, all of a sudden your universe is narrowed. So yes, today there's a lot of roller coasters about which one to use and how to use it, but we really took a conservative approach to say, okay, as a framework, let's make sure we can provide it all so that a firm, an enterprise, a wealth management organization can decide how to plug and play what they need at any time and evolve as the regulation evolves.
Very good. I want to come to, we do have some other things that I hope we might have time to cover, but maybe we'll be squeezed out. I definitely want to cover some of the questions that have come in from our audience though, because there are some very good and hopefully useful ones. The first, I'm not sure who it's from, but it says, the regulation always refers to advisors, in inverted commas, asking clients for their sustainability preferences. How does the regulation apply to self-directed online platforms where there is no advisor directly involved? I suspect Pilar and Jan.
Maybe, yeah, I can answer this one. Well, really, the regulation SFDR, so the regulation on disclosure of information, and also the MiFID II amendments apply to advisory, investment advisory, and also to portfolio discretionary management. But it does not apply when the client is not getting these services. So in terms when they are self-directed online with online platforms, it would not apply. With one important thing to highlight. What applies to them is the transparency requirements. So they are not going to be asked about, or they don't have to be asked about the sustainable preferences, but they have to receive information about whether their entity is integrating ESG factors, and whether the product is green or not, and whether it takes into account the principal adverse impacts. So it applies, but not in terms of suitability test. It applies in terms of transparency.
Very good. Okay. And there's another one from our audience. I should say that first question was from Alistair Hume. A second question from our audience is from Katrina Wood. She asks, do you expect the definition of sustainable investment under SFDR and the exact questions we must ask clients around their preferences to become standardized at some point? Or do you think the regulation has left flexibility/ambiguity on purpose? Pilar, that might be one for you as well, actually.
Under my opinion, the regulator has left flexibility on this. It might be that they end up giving a standard or a template, but I really don't think so. It has not been the approach in the past for the suitability tests. But it is true that there is a trend, for example, in Germany, in order to harmonize the test. So let's see where it goes. And but at this moment, I don't think that in the short term they are going to introduce a standard test.
Okay, Jan, as a sort of market participant, do you welcome that flexibility, or would you prefer ironclad clarity?
No, I think it's really important to have some flexibility. You know, when you talk to clients or you present your issue, sometimes you want to present it in a more, let's say, emotional way, or sometimes in a more technical way. So I think we need the flexibility. But obviously, as Pilar said, the risk is high that if the market misbehaves or there's misconduct, they will completely, resort to harmonizing that.
Okay, sure. And Lydia or Rudolf, would you have any thoughts on that, whether this element of flexibility is something that your platform could help clients negotiate, and does that feed into their decision making there, or not so much?
Yeah, I can absolutely say that. So we have multiple ways to implement this from our standpoint, including more simple classifiers that are using all the underlying frameworks mentioned, all the way to more customized full look-throughs of data so that you can make much more robust questionnaires and pull it through into internal platforms, etc. So absolutely, Rudolf said it well, it's not just about the flexibility of the data and the frameworks, but also the flexibility of how you implement the solution that works best for your organization.
Okay, excellent. And another question from our audience is, how will Indiana and Louisiana state attorney letters to BlackRock warning ESG policies are rampant violations of sole interest rule regarding state-regulated pensions, and in brackets, a violation of fiduciary duty, impact the ESG landscape? This comes from Richard Bojankovic. I hope I've said that right, Richard. And he's referring to an article that was in the Wall Street Journal a week or so ago. I don't know if that rings any bells with anyone, but Lydia is our resident US correspondent. This might be one you have a view on.
Yeah, let me just put on my legal hat. Oh, wait, I don't have one of those. But I think, it goes back to what Jan was saying, is this headline in the US can be seen from a positive light because people start to learn, what is ESG? Why are they doing this? Right? So although at first blush, it's, this is bad, I think the more you dig in and the more headlines we get, the more we all learn and can actually stop labeling ESG as some generic, which is liable to greenwashing. So I think from a positive spin from this correspondent here in Miami, Florida, I read it as good in a way.
That's what I meant with the reactionary forces before. I mean, to some extent, I think there's a big misunderstanding currently and a big battle also around ESG going on in the world. And that is because people don't really understand that there is not sustainable investing, but actually there are three different approaches. And obviously, I mean, it comes down to history. It started with, Mormons, Christians, excluding some things. That was the values-based approach. Now the ESG approach is about using the ESG data and making sure the company is it's impacting and seeing how it's impacting the bottom line of a company, right? So it's financial materiality, and that is within fiduciary duty. Obviously, not values-based investing. That's not in the fiduciary duty, but ESG is obviously fiduciary duty. And what we see now is in Europe is the shift towards more impactful investing to make sure that the companies also don't have an effect on the society, or a negative effect on the society or the environment. But this ESG approach, obviously, they have misunderstood what it is and are probably not learning. Mr. Barr, I mean.
Very good. Well, we are running out of time, but I'm very pleased we did have a chance to meet those questions that have come in from the audience today. Before we wrap up, though, I wondered if we could ask our panelists for one sort of word of advice or phrase or sentence of advice that they think encapsulates the issues connected to the discussion that we've had today. Very hard to summarize something so complicated and difficult to get to grips with, but it's a task that I think you're all more than equal to. So perhaps I can start with you, Rudolf. Can you tell us, what you would say to the people listening today? Is there one piece of advice for getting to grips with this world of sustainable investing, AI, data? What can you tell people?
Okay, I would have two pieces of advice. The first one is that the choice of your sustainability data provider is becoming very strategic, because you are going to use sustainability data in many ways, and you will not be able to hide behind your sustainability data provider when being challenged by the regulator. So this relationship with the sustainability data provider has to be a relationship of trust and in-depth understanding about what you're providing by the sustainability data provider with enough transparency and with enough transparency. So that's the first piece of advice. And the second one is that when it comes to sustainable investment, more and more going forward, what's going to matter is not the process, it's going to be the outcome. So the ability to demonstrate that you have a positive impact on the outside world. So you might have very complex regulation to implement and this is taking a lot of your resources, but just keep in mind that what final investors are going to hold you accountable for is your ability to demonstrate positive real world outcome and more so going forward.
Very good. Pilar, can I come to you next?
Well, very related with what Rodolphe just said. Well, I think that really it is important not to stay just in compliance. really ESG regulation brings also a great opportunity. So a strategic approach in order to will really implement and embed ESG in the firms in order to provide investment services is crucial in order to guarantee the best quality services for the clients, but also the position in the market.
Very good. And Jan, can I come to you next?
Yeah, I would call out to all advisors and say sustainability is a journey. Just start it. Look at data providers, look at the right solutions. Of course, it sounds now a bit easy. We're with Radicant, of course, at the cutting edge of sustainability. But just start the journey. It's you don't have to go right to the end. Just start the journey, because expect a yes when you are asking your clients about sustainability preferences. Most clients will usually say, yes, why not? Why not? If the risk return profile is more or less the same, which it is. And then you have to come up with an offering, and you have to provide, or while we have to admit that this MiFID thing and SFDR is a bureaucratic monster, in the end you speak to clients and try to find easy questions and not bureaucratic questions. Try to find an engaging dialogue, and it will actually benefit and keep the client with you once you've convinced the client about that this is the right approach to take. This is my advice.
Very good. And Lydia, the last word to you, please.
Yes, I guess it's be where the puck is moving. So act fast because regulation is now, but think towards the future and partner with somebody that can configure towards the evolution of this topic.
Fantastic. A great note to end it on. All that remains for me to do is to thank our panelists, Pilar Galan from KPMG Abogados, Dr. Jan Amrit Poser from Radicant, Rodolf Bocke from Clarity AI, and Lydia Pinnell also from Clarity AI, and of course to our kind sponsors, Clarity AI. I've been Edwin Smith. This has been a Spears webinar, and we're very grateful to you all for joining us. Thank you very much.
Thank you.
Thank you.
Thanks.
Thank you.